Hello friends, welcome to our live lecture series on financial management. We are today going to start our discussion on a very important topic of working capital management, that is static view of working capital. In previous lecture of mine, I told you about the dynamic view of working capital, where we discussed that what exactly we mean by dynamic view of working capital, what exactly is the operating cycle approach, and the way we implement it into the calculation of working capital requirement or required via operating cycle approach. So in today's lecture, I'll be telling you about the static approach of working capital management, which was briefly discussed at the very outset, that what exactly is the static view of working capital. But today we'll discuss in great detail about the static view of working capital management, and then I'll tell you how to do the calculation of working capital requirement via static view of working capital management. Moving ahead, we'll be talking about the determinants of working capital management. What are the different determinants of working capital requirement or working capital management? What are the different factors which are going to affect our working capital requirement? That is what will be our topic of discussion today. So let's start with the static view of working capital. What exactly is the static view of working capital? As per the static view, the working capital can be defined in two different ways. When we start with the static view of working capital, it can be defined either as gross working capital or as net working capital. When we say it is gross working capital, it means we are talking about the investment in current assets only. So when I say gross working capital, it means whatever is my total investment size into the current assets, that is going to be regarded as my gross working capital. Say for instance, into my balance sheet, if I cast my eyes onto this particular component of current asset, I can find the presence of cash in hand, cash at bank, inventory, receivables, and at times accrued income. So these are the components which are actually which are actually comprising of this particular term called gross working capital, or you call it as current assets. So whatever investment, whatever money is being logged or blocked into this particular component of working capital, that is known as gross working capital. And the moment we find the comparative value, we find the differential value, that is from gross working capital minus current liabilities, we come to know about the net working capital. Which means in order to get our net working capital, we'll have to look towards the current liability also, the corresponding current liability also, that what is there into the current liability. If we look at the current liability, there we find the creditors, we can find bills payable, we can find outstanding expenses, we can find unaccrued income, and many other items into the current liabilities. So when we have to calculate net working capital, we have to find the differential value of current asset minus current liabilities, or you can say gross working capital minus current liabilities, in order to arrive at net working capital. So these are basically the two broad definitions of working capital requirement as far as static view of working capital is concerned. Now at times my students are asking me that why do we call it static view? Why it is regarded as a static view of working capital? Why do we call it static? It is static because it is based on the data which is static in nature. Remember, whenever we have to take the components of take the values of current assets and current liabilities, we'll have to refer to the balance sheet, and balance sheet is always provided on a particular date. So on a particular date, those values are given into our financial statement, and since those values are given on a particular date, they may change in the due course of time. With the passage of time, they tend to change, and actually they change. That is why what we do, we try to understand that since these values are based on a particular statement, financial statement called balance sheet, and that was on a particular date which is actually static in nature. So since we are relying on to a data which is static in nature, that is why whatever view or whatever opinion we are going to formulate, that is going to be static in nature. So the same nature we are supposed to derive. That is why it is regarded as static view of working capital. We shall be discussing also about the drawbacks of this particular view of working capital in due course of our discussion, that why exactly it is not a complete method of computing working capital, but still it holds importance. That is why we are studying it, we are trying to understand, and we very often try to draw the inferences out of this particular kind of calculation. So in static view of working capital, we have broadly two definitions. One is gross working capital and the other is net working capital. The question comes, how do we calculate working capital requirement? If we look at the format of computation of working capital requirement, we start our journey from current assets. In current assets, whatever the components are given into the balance sheet, all those components are recorded as it is. The value which is given into the balance sheet, those values we have to take out from the balance sheet. Say, we have to start from stock of raw material. There can be an inventory of work in progress. There can be inventory of finished goods. So even if we talk about the inventory or stock can be of three types. One is your raw material, the other is your work in progress, and third is your finished goods. So we have to take all the values of inventory separately. Then comes the turn of receivables, or what you call as debtors. Whatever value of debtors are given, those values also we take. Then there is cash and bank balance, cash in hand or cash at bank. If it is given, they also form part of your current assets. And in this way, when we aggregate all these items, we collectively call it or term it as gross working capital. So the aggregated value of these particular components of your current assets, they are regarded as gross working capital. Now here comes the role of the second part of your working capital requirement calculation, that is our current liability. We once again refer to the balance sheet. We take the items of payables, you can say sundry creditors, or whatever the items are given into our current liabilities. All those current liabilities are taken, and collectively we call them the total current liabilities. And once it is written here, we can find the difference between these two components, that is current assets minus current liabilities, and whatever we get as a differential value, that is our net working capital. But remember, my dear students, since this particular computation of working capital is coming out of static view of working capital, what we do in order to avoid those changes which may occur in due course of time, we actually add certain percentage of margin for contingencies. What if some contingency arises? What if my debtors are not paying on time? What if my creditors, they are demanding my creditors are demanding for the payment on an urgent basis? What if I have to avail some cash discount, and for that I need certain amount of cash available, easily available or readily available? So in that case, we are adding 10% margin for contingencies, which is added to the amount of net working capital so calculated. That is gross working capital minus current liabilities. Whatever we get, we term it as net working capital. And the moment we add the margin for contingencies into that, the resultant value is known as working capital required. So in this way, as per static view of working capital, we can calculate the requirement of working capital by adding the margin for contingencies. And that is our duty also, because the margin for contingencies is very important. At times in question, we don't provide you the the margin for contingency, the rate is not given. So normally the industry trend is that you have to add 10% margin for contingencies. Here it is my duty to tell you that at times we come across a balance sheet where the working capital is negative, where the gross working capital comes to be negative, and students are thinking that, sir, we have always been got this kind of idea from the working capital management analysis that working capital need to be positive. We need to have a current ratio of 2:1, which means we should have at least 2 rupees of current assets for meeting out the liability of 1 rupee. Being very conservative, we are having this kind of practice that current ratio has to be 2:1. So in the light of that, in the background of all this learning or understanding, what we feel, if the working capital is negative, it means company is not good. My dear students, with the changing format of business nowadays, you can find number of business houses, number of companies where you find the working capital to be negative. Say if you take example of any company which is working onto online platform, what is happening? Their investment into current asset is zero, almost zero. They are not maintaining any inventory. They are basically advertising the products of different companies on their portal. The advertisement is the images of those products are there, the price is displayed, and remember, the inventory is maintained by the supplier itself. So we are not maintaining any inventory with us. We are not investing a single rupee on account of inventory, nor we require any cash or bank balance. So with zero inventory, practically what we are doing, we are simply acting as an intermediary, where we are passing on the information from the supplier to the customer. We are actually acting as an intermediary, and what we are doing onto that platform, we are receiving all the cash from the customers, whether it is cash on delivery or it is the payment in advance. What is happening? The money is actually kept with the intermediary only till the term for the return policy is over. So what is happening? I'm actually, as a service provider, I'm keeping money of my supplier without paying any interest to my supplier. So effectively, all cash which I am keeping with myself is actually my current liability. It's no more my current asset. There is no investment from my side. I'm actually keeping the cash of my suppliers, and after the completion of term, what I'm doing, I'm deducting my commission and passing on the money to my supplier. So effectively, what is happening? I'm having all current liabilities. If I'm making payment to my customers are making payment to me, the money which is with me, that is my current liability. Inventory investment is zero. So effectively, on current asset side, if you look, there is no investment, there is no value. Whereas on the current liability side, you have a list of liabilities. So what is happening? The current liability is greater than that of current asset, and you find the working capital to be negative. Nowadays, it is regarded as one of the best practice in terms of financial management, because we feel that in this kind of business model, without zero investment or very nominal investment into working capital, the firm is actually carrying out its business. So while drawing the inferences, we have to look into the type of business format we are into, and then accordingly we can give a judgment whether this situation is right or wrong. So we cannot say that in all situations current ratio has to be 2:1, or we cannot impose this kind of condition that if current asset is greater than current liability or net working capital is positive, then only company is into a situation of good financial health. We cannot have this kind of inference unless we understand the type of business format in which we are dealing with. So we have to understand, my dear students, while drawing inference out of net working capital, we have to keep this thing in our mind. So with this input of static view of working capital, the way we calculate the kind of margin we are adding for contingencies, now it's time for us to implement all these understandings in terms of a numerical. Let's see with the numerical example, how do we calculate working capital requirement as per the static view of working capital. So let's have a look at the question. We have a problem called problem number 1 from the following projections of REMA Limited. For the next year, you have to determine the working capital requirement for the company. The company is reporting you that raw material is rupees 5 lakh. The company is further reporting that work in progress constitutes 3 different components: raw material, direct labor and overheads. In raw material, they have investment of rupees 2,80,000, direct labor involves rupees 50,000 and overheads rupees 8 lakh. So while computing work in progress, we shall be aggregating all these values. Remember, these values are taken from the balance sheet only. Next item into this next item into this particular list of information which is available with us is stock of finished goods rupees 9 lakh. Debtors amounted to rupees 20 lakhs, cash at bank rupees 1 lakh, creditors rupees 4 lakhs, wages unpaid, or you can say outstanding wages, rupees 10,000, and the question is indicating that you have to add 10% margin for contingencies. So you have to add 10% margin for contingencies, and with the help of this information you have to calculate working capital required. Now the question has no mention of whether we are following static view or dynamic view. But with the kind of information we are going to deal with, we are very sure that it is actually a static view of working capital, because we are relying on to the data which is provided by the provided in the balance sheet, or you can say into our financial statement. So let's solve this particular question. We shall be taking current assets. We shall first be writing working statement showing working capital required. We'll be starting with the current asset, which is the first component of working capital. Stock of raw material as given in the question is rupees 5 lakh. Stock of work in progress, as I told you, we have to aggregate all 3 components of working capital required, whether it is material, it is labor or it is overheads. We shall be aggregating all those components of work in progress. Remember, while writing the amount of work in progress into our working capital requirement sheet, we will have to combine all the components of work in progress mentioned in the balance sheet. Suppose if the question is giving you the opening stock of work in progress, closing stock of work in progress, then obviously we have to take closing stock of work in progress. So we shall be taking closing stock of work in progress, and if work in progress comprises of material, labor and overhead separately, all all separate informations need to be aggregated to arrive at the net amount of work in progress, and that is what we are going to do into this particular problem. We shall be aggregating raw material rupees 2,80,000, labor rupees 50,000 and overheads rupees 8 lakh. When we aggregate them, it becomes rupees 11,30,000. Once the finished goods, once the work in progress is over, the next item into our balance sheet in the list of current asset is stock of finished goods, which is given in the question 9 lakh rupees. So as it is, we shall be writing Debtors are written to be rupees 20 lakh rupees. Here you need to understand, if in your question the amount of debtor is given and provision for bad and doubtful debts are also given, so you have to take the net amount of debtors, not the gross amount. So we shall be taking the net amount of debtors after deducting the provision for bad and doubtful debts. Whatever is my net debtors, that is my investment into debtors, that amount of debtor we shall be writing. So whatever bad debts which has been incurred, that need to be deducted. So in this question the amount of debtor is given, that amount we shall be writing here, that comes to be rupees 20 lakhs. Cash at bank or cash in hand given in the question is rupees 1 lakh. In this way we have taken all the items which belong to the category of current assets, and once we aggregate them, what we get gross working capital, and if you make total of it, it becomes rupees 46 lakh 30,000 rupees as far as this particular problem is concerned. So what we have to do, we have to first take out all the items of current assets and we have to add them, we have to aggregate them to arrive at gross working capital. So this is actually as per the first definition of static view of working capital, which is actually giving you the concept of gross working capital. So we have computed the amount of gross working capital. The next step will be, we shall be aggregating, we shall be selecting all the items of current liabilities, we'll be aggregating them and deducting it from gross working capital in order to arrive at the net working capital. When we deduct, when we take up the current liabilities into that category, we have two items given in the question. One is the amount of creditors, which is given to be rupees 4 lakhs. Outstanding wages or wages unpaid, which is given in the question, is rupees 10,000. When we aggregate them, the amount becomes rupees 4 lakh 10,000. And the moment you deduct the current liabilities, which is actually 4 lakh 10,000 from 46 lakh 30,000 rupees, you get net working capital, which here in this question becomes rupees 42 lakh 20,000. So this is my net working capital, and as question suggested, we have to add 10% margin for contingencies. The question comes, this 10% has to be calculated on which amount? Unless otherwise mentioned, we do this calculation on net working capital, and here it is 42 lakh 20,000 rupees. When we calculate 10% of it, it becomes rupees 4 lakh 22,000. Now this 10% margin for contingencies need to be added to our net working capital requirement, because it is actually over and above what our net working capital is, and once we have to show that what is my working capital required, that becomes rupees 46 lakh and 42,000. So in this way, as per static view of working capital, what we have done, we have computed working capital requirement. So simply speaking, what we have done, we have taken the item of current asset, deducted item of current liabilities out of it, resultant value was net working capital, and the moment we added the margin for contingencies, very simple, we got our working capital requirement. So this is what we have to do when we are following static view of working capital management for computing our working capital required. My dear students, while dealing with the examination problems, what you have to keep in your mind, that either question will ask you to make the computation of working capital required as per static view or as per dynamic view. As per static view, they can also provide you the financial statement of a company straight away, that out of this financial statement of this company you have to calculate working capital required. Very simple, from the balance sheet you take out current assets and current liabilities, all those items are listed. The new format of the final account financial statement as per schedule 3 is actually indicating what is current asset, what is current liabilities. Very simple, you have to take those items, deduct it, and into the differential value you have to add margin for contingencies, and in this way you can calculate working capital required. So as per static view of working capital, fortunately we don't have a separate formula for computing the different components of current assets or current liabilities, unlike that particular dynamic view of working capital where we were exposed to different types of formula. For each of the items we had a set of formula which we have understood, which we have already dealt with and computed the amount of working capital required. In order to have a comparison, we can have a look at another type of question of dynamic view in due course of our discussion, so that we can compare in one go that what is going on into static view and what is going on into dynamic view. While dealing with the static view of working capital, there are certain drawbacks, cause of which still most of the companies, they are relying on to the dynamic view of working capital only. What are those drawbacks? That need to be discussed, that need to be elaborated here, that why this static view of working capital is not a complete method, is not a right method or appropriate method to rely upon as far as computation of working capital requirement is concerned. So we have to understand that the working capital under this view is basically computed by using the data given in the balance sheet, which is static in nature. So whatever data I am taking from the statement, that statement is static in nature. So since that statement is static in nature, whatever computation I am doing might be possible that it is you can say the far different from the reality. Might be possible that I am computing the current asset of rupees 15 lakh rupees from my balance sheet, and if I go to the business for physically vouching that amount of current asset, it may be significantly less than or greater than the amount which I have taken from the static statement, that is called the financial statement. So this is the very basic drawback of this particular view of working capital, and cause of this only it fails to reflect the dynamic nature of working capital, which is very much crucial nowadays as far as decision making is concerned. Remember, we have to take decision in time. Our decision should be relevant, and in order to make it relevant, our information on which we are basing that need to be very much updated, very much relevant. And that is why this becomes the first and foremost drawback of this particular view of working capital. The net working capital, which is computed as a difference between the current assets and current liabilities, it actually doesn't reflect the correct amount of working capital due to various reasons. And what are those reasons? The first very reason which is counted here is short-term bank borrowings. Short-term bank borrowings, which are actually used for financing current assets, they are unfortunately shown separately under the head of secured loans, and they are actually not forming part of current liabilities, whereas they are basically acting as a source of financing your current assets. So whatever requirement I have, I am going to the bank for short-term borrowings in order to meet out my financial requirement of working capital, but that is not being shown into the head of current liability. So that is the first very drawback of this particular current liability, that this short-term bank borrowings are not forming part of our current liability. The second drawback is, suppose if you are going for accepting public deposits in order to meet out your funding requirements, you are going for short-term public deposits and it is utilized for financing current assets, but they are shown under the category of unsecured loans and they are not included in the current liability. So due to these reasons, what happens? Whatever calculations we are doing, they lead to miscalculation of the amount of working capital. So whatever amount we are getting out of this kind of computation, it may be misleading. Although some of the accountants, they are saying that it is giving you at least a realistic view, because you are relying on to the components of current assets and current liabilities, and whatever changes which may occur in due course of time, for that we are having a cushion called margin for contingencies. It may be sufficient in certain cases, but not all the time. So we have to understand, cause of this limitation only, we got a new method called dynamic view of working capital, a new approach called dynamic view to working capital management. I'll not be demotivating you that you should not go for this particular dynamic view of static view of working capital, cause it is very much in practice. Most of the business houses, they are actually making use of this view of working capital, dynamic view of working static view of working capital along with dynamic view of working capital. In order to have a better understanding what they do, they actually have a comparative of static view of working capital as well as a dynamic view of working capital. So both are actually acting as a complementary to each other in place of taking them as competitor of each other. This is what we do into this particular both views of working capital, that is static as well as dynamic view of working capital. Once we have understood about the static view of working capital, it is very crucial and important for us to discuss what are the different determinants of working capital, what are the factors which affect the amount of working capital into our business. We have to understand that there are no set rules and formula to determine the working capital requirement. We can't have a single formula which can give us the exact amount of working capital requirement. We have to understand that there are large number of factors and each of the factor is having different importance, in terms of affecting the working capital requirement. So each of the factors or determinants which are going to affect our working capital requirement, that need to be discussed, that need to be understood not only in terms of quantified values, but also in terms of qualitative effects also. Importance of factors, they also change with the passage of time. Might be possible today one factor is prominent, and after a month or after a year, what happens, another factor which was earlier not that important have actually become more important. So cause of these happenings, we have to understand that analysis of these determinants is very much important for a business house. We have to understand that what are those possible factors or determinants which may affect our working capital requirement. So let's try to discuss some of the important determinants of working capital. The first very important factor which is going to affect our working capital requirement is the very nature of business, the kind of business we are into. And I'm telling you, my dear students, this is actually going to decide not only the composition but also the direction of your working capital requirement. We have to understand that there are different types of businesses. If I take example of trading and financial firms, they have a very small investment in fixed assets. If you take example of any trading or financial firm, their investment into fixed assets is very nominal, but they require large amount of working capital. Just because of this, that they have to make investment into multiple stock keeping units and cash. Since if you go to a shop where a company is having a trading kind of business, what is happening? They have to maintain say 20,000 stock keeping units, and those stock keeping units, they require huge amount of investment into inventory, and cause of this inventory we require cash. So it depends that if you are actually having a kind of business where you are trading or your business is dealing with the financial transactions, what will happen? Your investment in fixed assets will be nominal as compared to your investment into current assets. So you will definitely require greater amount of working capital. Whereas if you talk about any company which is into public utilities, into service providing, what happens? If you go to them, since all the transactions what they are making, they are in terms of cash. So they are in they require limited amount of working capital, but huge investment in fixed assets, because they have to ensure that service is properly provided to our customers. And since they have all cash sales, what happens? They don't require any amount which is to be invested into inventory or into your particular debtors. So you have to understand that what is the type of business we are dealing with. Most of the manufacturing firms, they fall between the two extremes. If you talk of manufacturing firms, they are actually falling between the two extremes. They neither require less amount of cash nor they require the huge amount of cash. They actually require the moderate quantum of cash. So nature of business is the one factor which is going to decide or determine the quantum of our working capital requirement. Not only that, there is another factor called market and demand conditions that is also going to affect our working capital requirement. Advanced planning for working capital is required for a growing firm on continuous basis. If your firm is growing, you require greater amount. If the demand condition is in the market is very on a lower side, obviously you don't require that much of working capital. If demand is very high, we require greater amount of working capital. Apart from this, we have another factor called technology and manufacturing policy, which is also going to affect the working capital requirement of a firm. If manufacturing cycle, it comprises of the purchase and use of raw material and production of finished goods. Longer the manufacturing cycle, larger will be the firm's working capital requirement. So this technology and manufacturing policy is also going to affect our working capital requirement. The next and very important factor is into this particular discussion is availability of credit from suppliers. If your suppliers are providing you greater amount of credit, your requirement of working capital will be less. But if your suppliers are not providing you credit, your requirement of working capital will be greater. So apart from this, you have to understand that operating efficiency, it also affects the working capital requirement of a firm. Price level changes, they do affect the working capital requirement of a firm. So in this way, my dear students, we have discussed the static and dynamic view of working capital requirement or management, not only in terms of numerical discussions but also in terms of theoretical understanding. I hope you must have understood the entire discussion. Thank you so much.